Baker. This is my good friend Robert Marson from Philadelphia. I'm up here in Boston. And let's strike a blow for capitalism and see how we can make money for you folks today. Robert, what is on your agenda, my friend?
Oh, Mr. Bakes, I am finishing up the earnings reporting season for my companies. So I had a few report last week. One I didn't get to the last week that reported the prior week. So let's get the ball rolling here. One of the first ones I want to talk about is SimilarWeb, SMWB. That's a data as a service provider. And the stock got slaughtered in that SaaSmageddon a couple of quarters ago. Stock went from 17 last year at its peak, I believe, to about 2.5, 2.25 in the last few months. You would think the business is going away with that kind of stock performance. It's kind of hard to go away when you have almost $1 a share in cash and no debt, and the stock is 2 and change, and the stock is kind of working its way back to close to 4 on the quarter. The quarter was 10% growth. They increased their large accounts. They're trying to convert from a small, medium, and large client customer base to just large and perhaps the upper end of medium. And they're trying to get their customers to not pay on a monthly basis or pay small amounts. They're trying to lock them into 3-year contracts, and they made a lot of progress there too. So 2/3 of their revenue now is multi-year contracts from large enterprises, and that's a important thing for the visibility in the business. They sell data. They don't sell a software platform that processes it. They sell raw data. They supposedly have access to over 1% of all the clicks on the internet. They're global. A lot of the data gets sold to online brands or brands that want to know what the customers are doing online when they see an ad, when they click through to the website, when they place an order for a product. And that's what this company monitors. They're one of those annoying companies that creates the data from your cell phone and PC use and sells it to the companies that you're looking at on, in your apps or on.
They're good at it, apparently.
Yeah, they're one of the oldest ones doing it. They've been doing it around 20 years. They're Israeli based, but they're very Americanized, and half the revenue is U.S. and half is the rest of the world. Now, prior to SaaSmageddon, I had a formula on software stocks, and I bought the stocks when they went below 2 times sales because there was always someone that would pay 4 times sales. Lotus Notes would have been the first software stock I bought following this formula. So you can imagine how long I've been using it. IBM bought Lotus Notes probably 30 or 40 years ago, and I doubled my money in a couple of quarters. It was nice, not a home run, but it was nice. And since then, whenever software stocks normally trade at 5, 6, 7, 10 times sales, and they were that way about a year or two ago. I was worried about the AI influence on software stocks and said I would not buy a software stock with my worst enemy's money. Well, that turned out a SaaS company. That turned out to be right, by the way. But I expected the SimilarWeb to be viewed as a data provider in a world where data was becoming more valuable, even though they delivered it through as a service program. So instead of SaaS, it's DaaS, data as a service. And obviously the stock market didn't agree with me, considered it a software company, wonders if AI companies could do it yourself with AI and create their own data sources. So these guys have a fair amount of proprietary data, but it's probably more than half is taken from public sources around the world, and maybe 40% to a third is guessing and reading body language is proprietary. So
who's the number one competitor right now?
And the number one competitor is also their biggest customer, Google.
All right,
is the
makes sense.
After that, there's one called SEMrush that competes in a way, and they sold out to Adobe. I don't know if the deal closed, but about 2 quarters ago they announced it that Adobe 6 months ago, maybe a little longer, Adobe was buying them. If Adobe would turn around and buy these guys at the same valuation, I think the stock would be double digits, and it's three and change right now. So the company has a $200 million enterprise. That's about 280, 300 million market cap, 70 million in cash, and the revenue is over 300 million. So my formula of buying 1.5 or 1.7 times EV to sales for software stocks, if this stock would trade at that, the stock would nearly triple if it would trade at my old buy point for software stocks. So the stock's been punished. It's tried to build a base and creep back in here. I think it's bounced off the bottom like most of the software stocks, 30-40%. I'm just sticking with it, holding it. There's no reason to sell the stock unless you believe the data has no value and AI is going to let everybody create their own independent and cheaper sources of data. I don't think that's the most likely outcome. But if you're scared of that, and maybe many portfolio managers are, it's right now, they don't want to pay for a company that's growing 10%. It's not profitable yet because they're investing heavily for growth, but that's going to change. The CEO is going to retire. They got a new CFO. They're in a new era where they can't grow 20 or 25% like they were shooting for in the past. And so, they need to change their priorities and generate more cash flow for shareholders, which, talking to the company, they suggested the board is having those discussions right now about changing their business model expense ratios to generate more profitability.
Is the cash flow positive so that dollar in cash per share is growing, or is it
Yes,
burning?
they've been cash flow positive now for I think over 2 straight years on a quarterly basis. Yeah, so they're not burning cash. So they're at
Okay.
300
So the
million.
dollar's growing and gives you
Right, and then
net.
if they grow to like 500 million, they thought they could generate 20% operating margins, 25% operating. They have 90% gross margins, which is pretty stunning, and a lot of software as a service companies have those kinds of margins. So they it could be very profitable if they wanted to reduce their growth rate, but if the market reduces their growth opportunities for them, then they should pursue that path and become much more profitable. So high risk, high reward, not from any financials, but from the business model being negatively impacted by AI. But there's no evidence of that yet because their large customers grew and their multi-year contracts grew. And they argue that AI, that the large language models and the ability to use AI to process data will increase the value of their data to regular customers, to large and medium-sized enterprises, and will increase the value of their data to the LLMs. So they're in the process of trying to deliver LLMs with 8-figure annual contracts. And
Okay.
I think they have one, and I believe it's their biggest competitor. So if that,
What's the catalyst, Robert, that get this moving, if
I
any?
mean, yeah, the catalyst is they grow double digits and they turn AI over the next year to 2 years into a tailwind, and it increases the growth rate from where
Okay.
it is now, and instead of imploding the company's revenue basis, it's also so cheap that it could be the recipient of an unwanted affections of other companies because it's at a $200 million enterprise,
Okay.
low twos, it's dirt cheap. So if someone could clearly buy this company like they bought their Adobe bought their competitor.
Okay. Do you have a dream acquirer in your mind?
Well, yeah,
If you okay.
I would love to take Google stock.
Okay. Okay. What else you
Yeah.
got for me, friend?
Electrovaya, my Canadian battery company, reported, and it was mixed for me because the stock's been a good stock. It's gone from low single digits to double digits. It's up towards 10, and they're working on a lot of new business. They sell batteries into the material handling space, forklifts for the most part, and inside distribution centers, your forklifts can't catch on fire. It's better if they're not as dirty as lead acid batteries, and those are expensive things. So these guys have a high end, high power lithium ion battery that uses a proprietary ceramic separator that doesn't catch on fire. So they've never had a fire in one of their batteries. I think their oldest battery is now pushing 8 or 9 years, and it still charges up to 90% of capacity. So it has 10,000 charging cycles, and that's a good business. That gets them 20 to 30% growth. They have a whole bunch of new applications outside of forklifts, and they're going into defense products, electric submersibles, and where they need batteries on ships and in tanks and in they call them mules, trucks that carry stuff with fighting material next to soldiers. So they're getting all, and because again they're very long lived and they don't catch on fire, they're getting a lot of interest from the military, and they have interest from the ground service equipment for airports. And they have where it's still most of the stuff is still diesels, and the airports would prefer to have their ground equipment battery, any kind of battery, rather than belching diesel fumes on the tarmacs and while the planes sit. So it's a very logical use case for it. They're looking at heavy duty trucks. They're looking at earth moving equipment, mining equipment, and construction equipment with a Japanese company. So they got a lot of irons in the fire. We need the irons to get out of the fire and strike something because it's fire. And we need the branding done. So it's they generated 20% growth. They said they lost about 5 to 10% of revenue due to supply chain constraints from the war. So the number could have been closer to 25 or 30. They said they reiterated they would grow 30% this year in revenue. And it's just their biggest opportunity is taking these batteries that have so many life cycles and have do not catch on fire. Very significant. There's been a lot of battery fires in electric storage farms. They put them next to solar farms or natural gas plants, and they produce power at night when it's cheaper too, and then they sell it in the day. A lot of places now with renewables, you need lots of batteries. And when these storage facilities, these battery storage catch fire, you can't put them out. They've had to evacuate whole towns in countries around the world where they've had these battery fires. And since we don't catch fire, it's they should be in every. I told these guys to put on those flame resistant suits and get a flamethrower, go take a battery or two to the parking lot outside the window of the CEO of all the electric utilities and try to catch the battery on fire with the flamethrower. And he would show the CEO that, these batteries don't catch on fire. And they would probably get orders, but they don't have a single order from electric utility or the developers of these battery storage farms. So they've got to get into that market, and they're working on their product right now. It's in testing. It's in their property in testing, and they should have one by the end of this year. And they have a very logical customer for that. And if they got this customer, it would be transformational. Their largest customer for their forklift batteries is the largest internet retailer in the world. And that's not too hard to guess. Yep. And if that large internet retailer company decide to buy this company's battery storage system and enter into a contract to outfit some of their data centers with this product, that would be a massive structural change for the company's revenue growth outlook. So
the first venue for your pyrotechnic display would be in Seattle.
Yes, if they could get that company. Yes, they also have.
I like it.
Yes, they also have a very large trial going on with an airline headquartered in Atlanta to do their equipment in airports. So that would be a not anywhere near as large, but also another name brand. The point isn't just that I don't care who signs up for the first data center, right? Any of the hyperscalers work for me. It's just that they prove the concept and they get a working, production order from one of them, so that you could say now this TAM is legitimate, because the opportunity for forklifts is this big. The opportunity for battery storage for data centers is far bigger.
Yeah. Yeah.
So that's the key, is to get any. I think they said they're in talks with a couple hyperscalers about using their battery storage systems. So it's a game changer if they land any of these two or three data center companies they're talking to. They happen to have a very good working relationship with one of them, because that one of them is their biggest customer. They've been using their batteries for a long time now in their forklifts, and they actually want to use them in more of their non forklift products, like delivery drones and other stuff like that. So that's their venue for growth. So this company is only going to do $100 million next year in sales, 120. And I think in 5 years they could be a $500 million company if they get some of these battery storage systems in the queue teed up for some of the hyperscalers. That's dope.
Yeah. I'm a fan of the chart. You're resting in a logical place here back at the 2020 high, and you're consolidating there, but you take out this 1188 recent high, and I think it's Katie bar the door, and then you go after 16 and 20, these other peaks that you see here back in 16 and 2009 10, and I think you're off to the races. So I think I like it.
And that's all I got. That's two of the best updates I could give. They were the last two
Okay,
companies that had a report.
not Sheeran T.
Yeah, I'll save that for next week.
Okay, fine. Ben, welcome back, my friend, to the show that never ends. I'm so glad you could attend. Come inside.
Yeah, sorry about that. Sorry, had a little hiccup this morning. We're running late. How you guys boys doing today?
Fabulous. I got three things. If you want to bring something on at the end, but this is I love to go through all my charts. I'm about through all my ETFs, but I also want to go through individual names that we've talked about in the past. And I'm also intrigued where the long-term chart is so much higher, the price is so much higher that it's like hitting a homer, or hitting a fly ball in the old Astrodome. And I can't even see it because it's 150 plus. This is Enphase, ENPH, and it was a short punching bag for a long time, and for good reason. Solar panels were about as popular as typhoid for a while, and the inventories picked up, and it looks to me like that's over. And if you want to talk about solar, you're getting a tailwind. $100 oil is a pretty good one, and is backed up by the chart, especially today. Is taken out this 5283 here back in February. The volume is absolutely fantastic, as you see right here. It's a breakout until it fails, and it doesn't feel like it wants to. Here's the long-term chart, and here's what I'm talking about. This is the weekly, and I think the peak might have a 2 or a 3 in front of it. I can't get it on my charts right now because the damn price was so high that it won't register. Oh, hold on, here we go. Yeah, I mean it peaked out around $2, and here we are at 56.75. This is solar panels. If I didn't say that, ENPH. It's just a clear turnaround in the chart to me. It is breaking to the upside, the Dow trend line that existed since for 2 years, and I don't know. I'm intrigued. I haven't found any yet, but I'm gonna go look for ETFs where this is a big percentage. But solar looks like it's back, and first solar looks pretty good. This is Enphase ENPH. Full disclosure, I can't own individual names, so that's why I'm looking for the ETF where I might be able to get some exposure that's meaningful. So stay tuned. But I think that solar's catching a bid, Enphase is catching a bid, and it looks like it wants to continue. And no one cares. Okay, back to you in the booth, Keith. My next one, where maybe people care. I'm kind of encouraged the fact that got crickets, because that means it's probably going to work. Uber is below the 200-day, which is a nightclub at 2 a.m. where nothing good happens. But I'm encouraged by these big volume days that are occurring, and I think it might be acting, more like the app that the self-driving cars are summoned by, and less than a DoorDash correlation play. And obviously, DoorDash is very expensive in terms of what they charge you to bring your Big Macs to you. And given the surge in gasoline prices, it's understandable that business gets hurt. It's roughly a third. Don't quote me on that, but that's about what I recall. The contribution to Uber Technologies business is their Uber Eats, and it looks like that's all getting digested, pun very much intended. And I think that this is a base here that looks like it wants to stay here. If it takes out this 84 level here, intermediate highs, and the 200-day moving average, it's encouraging to me. So apparently they keep beating numbers. The longer term chart looks a little more constructive. So let's see what happens over the next 2 earnings reports. But Uber, I think, is basing here and looking for a turnaround.
All right.
And last but not least, and this is just me being honest with myself and with you, someone asked me the day to record a video for, what would I invest in for 10 years? And there's virtually nothing. And uranium is about the only thing I have on my list that I think has a 10-year positive uptrend. But this is the Themes Uranium and Nuclear Group, which acts more like a utility stock, with the whole yield curve going up, interest rates going up, and less of a long-term solution to all the electricity we need for data centers and other. So I sold my second third of URAN. It's a 5% profit, so it's not catastrophic by any stretch of the imagination. But when I think I'm right, but the market tells me I'm wrong, I go with the market, at least partially. So I'm 2/3 out of URAN. I've made some money. I'm holding on to another uranium ETF, the junior miners, and stay tuned for that. Spot uranium is around 84, 85, 86, depending on the day. I think the resolution goes to the upside, but we'll see. I think the demand for uranium is going to be monstrous just from China and India alone. You don't need to have anything new happening in the U.S. So, but I'm honest with myself and with our members. Right now, I'm quote unquote wrong on my second third of uranium. I took my 5% profit, and I'm going off into the distance. I'm now 40% cash. I'm looking, to be an overweight point guard coming down the line and dishing to either the bull side or the bear side. Back to you, Ben.
Little alley-oop dunk for Robert Marson from the wing,
Yeah, exactly.
Flying Marson. Did you guys see any of the S1 from SpaceX yesterday?
I did not.
I haven't read it because I'm having everybody read it to me. So I'm being a little bit lazy. And it's funny. It's if you dislike Trump and Musk, you're finding every negative money-losing thing you can about it. And if you're a Musk fan and an optimist, then you're finding why it's the greatest thing since sliced bread, and it's the future of America.
Yeah, so I think it was early April on my podcast, Betting the Squirrel and I did a co-author report on it. We valued it, and then we did a podcast on it. And so I'm kind of up to speed on this, and
Good.
I love IPOs anyways. So being the biggest IPO ever, I figured I'd get into it. This thing is an absolute joke. I mean, we're talking about $2 trillion. These guys, Robert, they have $6.5 billion of EBITDA, and now
Right.
six and a
I
half
own
billion.
it. I own it, guys. I own it in a fund that owns it. I have a little private equity investment that owns it directly in a fund. I got like $100,000 of my money in it, so I'm happy.
Well, I mean, yeah, it was a good thing to be involved with if you bought it in the private market. I mean,
And
even
that,
as late as
and that was an 800 million value. It was worth about $100,000. So if it's
Wow.
That's a
Cheddar.
good one. That's a
big
good
party
one.
in Flower Town on me.
Coming to Philly, baby.
Cheesesteaks for all my friends.
I'll fly all the crew out on privates, and we can have a party in my
Love
big
it.
house.
Love it.
It comes out that like 2 weeks ago, and I think I sent this to our chat, that they are going to rent the Colossus data center in Memphis, which is 2 gigawatts of power and 550,000 GPUs. Maybe 95% of them are H100s. They're going to rent it to Anthropic, right? Yesterday, the terms of the deal came out. They're paying them $1.25 billion a month. So they're getting 15 billion a year in income on that thing. And I kind of had assumed that, basically that they had a problem in the sense of they had an IPO coming and their EBITDA was just not there. And I say this as a pretty recently new Starlink customer, and I'm happy with the Starlink product. Starlink's a good business, and it's growing decently. But it's just, we've seen satellite businesses before. I mean, maybe 250, $300 billion business right now, which could grow farther. But like the launch business is a nothing burger completely. That's a 1 delta call option and being valued like a 25 delta. And then the XAI is a total hot dumpster fire that's losing engineers. I know that their best engineers are interviewing across, I want to say the street because that's how we talk, but across the valley, basically at all the big shops, they're losing them. And so now they got this like $15 billion boost plus whatever losses that they can recoup on it. So their EBITDA is going to be more like 25 billion this year. So then you kind of get like, oh, I'm, less insane. But like, I don't know, Robert. I called some real estate guys. Like, how do you think about income as a real estate rental guy? Like you don't put 100 times on that, do you?
No, you do not. No, you do not.
It's a 3-year contract. So the bull would say, okay, well they're getting 15 billion. Let's put a 5 cap or something stupid on that, right? And then you're going to say, oh well, it's a $300 billion asset. Well, I think we all know that like data center capacity versus demand right now is out of line. Anthropic's crushing. They come out yesterday and they doubled revenue. They're at 11 billion in revenue in the Q1, and they made money.
Mid-single digit operating profit. Big news. Yes.
Yeah. I think like 550 million of operating income on a little under 11 billion. So call it like 4%.
Right.
But whatever, making money, right? Like
Right.
I don't really care as much as I do that like they're gonna stop burning cash and they're doubling revenue. That's impressive. So and people are handing them cash hand over fist. So for them it's more about like hitting it while they're hitting it hot. But again, so if you put a 10 cap on it and you said, okay, let's say there's 2 billion of annual GPU depreciation, so over 10 years that's $20 billion. So you do 10 times 15 minus 20, so it's 130 plus the 250 on Starlink plus, I don't know, 25 billion for the launch business. That's probably generous. You're just coming out around 400, like 400, maybe uppers of 500, 600. But this 1.8 is just the stupidest thing I've ever in my entire career seen from a deal, from stock. It is just got to be the sign of the top, man. That's the way I'm taking it.
It's the sign of the top, my friend.
There's always a deal. Like Rivian 2021. Blackstone was the top of finance in 2007 when they IPO'd. There's always, AOL Time Warner for the .com 25 years ago. There's always a deal. And when you think about the fact that they had to change the rules for S&P and NASDAQ inclusion, right, to make it so that they can get included 15 days after the deal. Well, why would they do that? They're doing that because everybody who wanted Starlink is long. I mean, we got a guy in this panel who's long, right? So like like everybody was floating that stock around for a long time, and so it's not like there's just everybody and their mother waiting to get this. And you're floating $100 billion of stock. That's an enormous amount of paper. The green shoe itself is going to be, the 10th largest IPO ever. The shoe is going to be the. It's like bigger than the GM deal post GFC, and so I just come out of that and see, okay, well, they're going to bag hold the indices, and then the hedge funds are going to use leverage, and everybody's going to try and get it to do the hot potato game. So they get it across the line. Everyone sit on their stock for 2 weeks and then sell it to the indices, basically, and then that probably is that. And Anthropic probably comes. They're doubling. I mean, you got to think those guys are going to come at $1 trillion minimum. I know they're raising in the market right now $900 billion, but if they keep kicking ass like this, that could be even higher. And then OpenAI filed yesterday, so that's like
a lot of
$4
paper.
trillion of market cap that's coming to an S&P that's maybe 65 billion or trillion, sorry, with a T, and that's a lot. It's a lot, and everyone thinks in terms of like, oh, there's all this endless liquidity. There's endless liquidity on like a day-to-day and the mark-to-market and these market makers doing it. But like actual paper, that's a lot of paper that needs to be filled. And, where is the money going to come from? From the industry guys, they're going to probably have to sell other stocks to get that stock. So, yeah, I think this is going to be top of mind, these IPOs coming up over the next, month to 2 months, basically.
I've got my popcorn out. It's going to be a lot of fun.
It should be. I mean, it'll be fun for us to talk about as talking heads. It will be interesting to see if there's a short opportunity, because I do think if they get it across the line, it hangs in there. I mean, if that thing somehow by act of God is at $2.5 trillion, come on, what are we talking about? And so I think that its implications for the stock. Hopefully, Robert can get out, fly us all there, and go to a Phillies game, and then we'll see what happens after that. But yeah, that was kind of what I was spending some time on. It was funny, actually, Robert. I took the S1 and I ingested it into my Chinese open source LLM and had it build a financial model, working model, pretty good, with cap tables and DCFs and some of the parts, and the whole thing took like 5 minutes. And then and then what the funniest part of all is, again, I put none of my report, none of the YouTube podcast, nothing else. The only input was the S1 from the SEC, and the valuation came up with was very close to what we came up with. I was like, oh, that's great. So either we're good at this, or the robots are coming for our job sooner than you think, boys. But I think that was the these IPOs will become front and center on this market. Did anybody have any opinion on NVDA yesterday? I didn't really get through the print at all.
It's my kryptonite, so I recuse myself. I'm clearly not good at that. So
I see it's down.
The fact that it doesn't go up on blowout earnings for the second quarter in a row, but it's what, $35 higher. Someone brought up that it goes up on their customers' earnings reports, and by the time they show up, people say, "Yeah, we knew you're going to blow it out, so we're not going to bid the stock up anymore." And I think that's what happened.
I think that's right, Kevin. Because I mean, it's been since NVIDIA hasn't been crushing after earnings since 2024. I think since 2024, it's what you just said, where everybody and their mother, pod shops, everywhere, it's a fine-tooth comb. They've seen what other people did. They have a pretty good sense of what's going on. And then, the option sellers go in there and they sell both sides. And it just doesn't do a lot after the print. it had a rally and sold in the November 25, if you guys remember that day where they're like, oh, NVIDIA had a good print, everything rallied, and then the whole market reversed one by one that morning of Thursday, November 21st, and that was actually the bottom of that spring or that fall sell-off. But yeah, I just wonder, about the NVIDIA, because I kind of liked that stock in January. I pitched it on the show here.
Yeah, yeah.
And then at like 182, and everyone kind of forgot about it. And I guess it's a pretty good move. What?
In January 23, they did 27 billion in sales for the year. They guided to next quarter of 91 billion.
Yeah.
No one's ever said. No one. If any one of us would have put that on this show as a forecast, 4 years ago, 3 years ago, you'd have been laughed off the planet.
Yeah.
It's just insane.
Yeah,
but the problem is we don't know if the business model is profitable to the customers of NVIDIA yet. We know it is to Anthropic, but that's the only one, and we really don't know, how much, accounting, what kind of accounting they're using to report that 4% operating margin. So it's befuddling to me.
Yeah, I guess it's just like, I hear stories, and Robert and I read Ed Zitron about there's just warehouses of GPUs sitting around, and they comes out that Colossus data center that I mentioned that's getting 15 billion from Anthropic, it's only utilizing like 12% of the GPUs. Part of it's the structure; it's like built in a ring, and it's got to go through all the H100s first. So like that's a little beyond the scope of this show, but like the point is that I don't get the sense that the GPUs or the power guys are the constraint like they were in the early years of this AI build out super bubble. It seems more like that right now it's all the little analogs, the memory, and like there's just the more traditional areas that are not great businesses, but right now are having their moment, are what really where the action's been, right, Robert?
Yep. Well, I think Ed said like 5 to 10% of the announced data centers are actually under construction. So there's just lots of delays from approvals to memory to power to everything, and it's they told people 2 to 3 years, and it's more like 3 to 5 years to get Elon built one in record time, and he did a great job because he gets shit done. But everybody else is taking, way longer. The GPUs are purchased; they're paid for. They're not a risk to NVIDIA's revenue, but they're not being employed because the data centers that employed them are delayed so much. So I keep expecting there to be an inventory hiccup in the story, but it doesn't happen. So, I don't know why the demand remains so strong when the hyperscaler customers can't utilize the product they have yet because the data centers aren't ready for them yet.
Yeah, it is an interesting situation, but some of the like the INP and substrates. Have you ever looked at AXTI before? That stock's been in absolute. Let's end the show.
I talked about shorting that on this show a couple of weeks ago.
Sorry, symbol again, please.
AXTI.
PI, Peter.
AXTI.
Indium phosphide it makes, gentlemen.
Yeah.
They grow the crystals and make the wafers. That thing.
AXT Inc., right?
Yep, AXT Inc. Yep.
Okay, you want to short it? Go ahead.
Yeah, exactly.
That's
not a Kevin Short right there.
Let me
bore
you with
more like a short.
This is the peak. Fair. I can sense it.
Let me bore you with the numbers. They did 29 million or 25 million last quarter in revenue. So they're doing 125 million run rate. Does the market cap show up there? I think it's 6.5 billion. They could double sales again.
Yeah, 6.8.
Get $7 billion in market cap for a friggin' $29 million quarter. That makes SpaceX look cheap.
Well, Look at this thing.
But I
Wow.
happen to understand the industry they're in, right? The industry has 8 competitors, 2 or 3 of which are Japanese, 2 or 3 of which are Chinese, them, and everyone's doubling capacity. And there's a boom coming for the demand for their products. There's no doubt about it. But for the last 10 years, these guys have made a double-digit operating margin 1 year because there's just in technology, it's a commodity that they make. The commodity is in severe, demand right now versus the
Yeah.
supply. But there's a lot of Asian companies that are doubling their capacity too. Oh, and these guys need Chinese export license to sell product too, because they make a lot of their product in China. So good luck with that. So one of these days, that stock's going to go down 90% from some unknowable top.
Yeah.
$7 billion on a 30, and they said we're going to double sales next year, and we'll double them after that. So again, if they do, they'll do 300 to 400 million in 27, 28, 27, 300 million.
Okay.
Still 7 billion market cap.
Yeah.
I mean,
Fun game. It's a
regardless,
fun
I wish
game.
I had owned the stock. That was a good one. That's all I'm
Same
saying.
here.
I had
Same
a
here.
friend who pitched it to me at 2.
Wow.
Ooh.
He bought it at 2. He sold it at, I think, in the low teens. Took 6 or 7 times his money.
That's the thing when honestly is I have a volatility fund, and the real trick of trading convexity, whether it's the right tail in this case or the left tail when you're buying downside puts or your credit default swaps or whatever, is it works, and it's working, and it's going up vertically, and that when it stops working, it's gonna absolutely get destroyed, right?
Right.
And so it's always easy to look backwards at a chart and say, "Oh, I should have done this," right? Like, because ultimately you sell it in the teens like your buddy, and you're like, "God damn it, now it's where it is now." Or you're like me. I bought Bitcoin like maybe 150 first time I ever bought it, and then my ex-wife and I, like, we were getting married, and like it was at like 1600, or like, that's pretty good trade, like, not bad. This is in 2017, and then that shit went to $126,000.
Yep,
So it's
yep.
like it's tough. It's tough to like ride the lightning, if you will, on convex trades. In because even if you think it's going to be sustainable, like use the case of Amazon, right? Amazon ripped to the .com, then went down 95%, and then obviously, it ended up working out. But like, the drawdowns you take with these things, even if you're a true believer, are not the easiest things to ride. So, or look at Carvana. That thing went from like nothing, or I think the IPO was like 19, $20, goes to like almost 400, then it goes to $1, then or $2, and then it goes back to 475. Like, I mean, it's a game of taking the right mental approach to it, and just being happy with whatever you come out with, I think, as opposed to trying to play Monday morning quarterback.
Look at that thing.
Anything else, guys?
No, I'll go through how I handle parabolas at a future date. I've done it before, but we're running out of time. So
Yeah, okay. Let's just call it. Congratulations, Robert, on the Starlink. I hope you get out of there, and
God bless you.
drinks on you when I come out to Philly.
Yeah,
You got
amen.
it.
All right. Well, I'm Ben Bryant, Kevin Bakes Baker, Robert Marson. We're Wall Street Beats. We'll be back at you next week. Have a nice weekend. Enjoy the holiday.
Thank you. Happy holidays.
Take care, folks. Jen, thank you.
Thanks, Jen.
See you, gang.
Sorry I was late, guys.
All good.